Brian, you've got a single line. I love it. Watch the unemployed of America. Why are you looking at the tendency of the unemployed to get back to work?
Because that's where the disinflationary forces that Powell's going to be looking for and a lot of his dovish colleagues in 2022 are going to come into play. We need to see larger amounts of people re-entering the labor force, maybe entering for the first time in the next couple of months as the unemployment assistance from the CARES Act has run out. The question is going to be how many hundreds of thousands or millions of people are back in the labor force that could put downward pressure on wages, fill some of those 11 million open jobs, and forestall the wage price spiral that I think put aside the supply chain issues and demand shock we got earlier this year. That's really where the serious systemic inflation is going to be coming from. I do think we get there eventually in this cycle, but probably not in 2022. And I think Powell's crossing his fingers and hoping that that's the case as well. So big jobs numbers equal, I think, overall disinflation force for the U.S. economy and leave the Fed able to keep rates on hold for longer and prove those 9 out of the 18 that still think no rate hikes next year to be ultimately correct.
Brian, let's build on this. Let me bring you the forecast for the Fed for inflation next year and the year after. 2.3% for core PCE in 22, 2.2% for 23. Looking at the screen right now on the Bloomberg, what do you make of that? Getting back to 2, Brian, next year when they've missed it so badly this year.
So I look at this as, why is the equity market responding well to what the Fed did yesterday? That's an extremely dovish set of expectations they had. If you think about it, they don't think they're going to be really that close back to 2% next year. 2.3%, I would say, historically for the Fed is a pretty big miss. This year was obviously much larger than that. But if they're not even going to be back to 2% next year, and half the committee doesn't think they need to raise rates, and they're not going to be back to 2% in 2023, and you have a fair number of people who don't think they're going to be aggressively raising rates, that's a pretty dovish signal to the markets. And I dare say that the 9 that don't want to hike next year are more likely to be people in positions of leadership, probably Powell himself, and people who are more likely to be voting on the committee next year, in addition to whichever governors that President Biden decides to nominate. So I think it's going to be a pretty dovish makeup on the committee next year. A willingness to tolerate inflation. Powell really played down even the significance of 2.3% inflation next year, that wouldn't be something that households could feel substantially above their 2% target. So the overall playing down of inflationary risks, even if the forecast proved to be accurate, I think is an important signal for equity investors.
Do you think that they're underestimating, Brian, the pressures that are coming from supply chain disruptions that are persisting way longer than a lot of people thought?
Yeah, so he basically said that that's why the inflation forecast for next year went up, is because they're not seeing the supply chain pressures ease as quickly as they thought. But I've always seen this as sort of a demand story. We had a huge unexpected positive demand shock in the first half of the year because of the ARPA, the 1.9 trillion. A lot of that found its way right into people's pockets, just as they were able to go into an economy that was reopening and do a bunch of things they couldn't do for a long period of time. That's a one-off. We have high savings rates, we have really strong balance sheets, but that demand shock is a one-off. Yeah. And so I think as that has started to wear off, we're going to be more in a position to see supply and demand come into balance, even if some of those overseas chains remain relatively tangled.
John, Christopher Verone over at Strategist channeling Brian Nick over at Nuveen, and I love what Chris writes this morning, John, about the idea that we are near the peak growth scare. I think that beautifully captures the OMG out there.
Brian, do you think we are? And can you make a statement like that before we've got through earnings season?
I do think we've seen peak growth. So our mid-year outlook was, growth is peaking. What comes next? I can tell you our fourth quarter outlook is going to be just past the peak, but still a way to go. And I think we're still optimistic. We're still an overall positive view of where the economy is going to be going over the next 5 or 6 quarters. That includes a deceleration in year-on-year earnings growth, a deceleration in GDP growth, but there's still much more positive than negative out there. And I think when you look at the markets focused on something like Evergrande, when you see a panic like that on Monday, it doesn't come without context. The context is markets are jittery about a slowdown in growth. They're jittery about the fiscal mess that could be coming our way in the next 40 days or so. And they're just anxious overall about the declining pace of growth really everywhere in the world and the removal of monetary policy accommodation. I think more importantly, the fiscal cliff, with a lot of stimulus money basically wearing out and not getting renewed.
So which sector or sectors are most attractive out 6 months?
Well, I think you guys were talking about it just before I came on. When you have a period where the markets are going to be focused on low interest rates, decelerating growth, that tends to be good for some mix of growth and defensive stocks. That would tend to lead you to prefer the U.S. over international markets. So the next 6 months, relatively short time frame, I think we got to kind of stay where where we think things are going, what's been working well, I think will continue to work well as the market sort of anticipates liftoff from the Fed, tries to gauge when that might occur. But I do think there is some juice left in the cycle here. I think we're going to get a nice GDP number for this quarter. If we get anywhere near the 3.8% GDP growth target for next year from the Fed yesterday, I think cyclicals are going to have periods in time where they're running too. So we're spreading it around a lot. Growth and value, cyclicals and defensives, because the whipsaw in that trade from week to week, month to month has been extremely violent over the last really 18 months since the pandemic started. So
hey, Brian,
we don't want to get caught off sides on that. We're focused on selectivity, especially internationally, but also in the US.